Good day, everyone. Well, the market has been providing ample entertainment, making history once again with the mini correction that it had. As we all know, it's kind of unraveled in basically a day. It had been giving signs of approaching full levels, but then basically in a day, just completely caved in, and um, and now it's having a bounce of some sort. As I wrote in today's pre-market pulse, with all this money printing going on and China lowering rates, etc., and the banks lowering their reserve requirements, that's of course going to flood the system with more cash, and and we wouldn't be surprised to see the market baby step. Well, not necessarily baby step. Do what it did in October, or what it's done in the past. That is, it starts to approach old levels over the ensuing weeks. So we're just watching and waiting here for additional information. But right now, we're seeing that a lot of these patterns that were essentially destroyed by the recent market action. So we're going to have to see which patterns shape up the quickest if the market's going to have any sort of sustained bounce here. Likewise, we're also looking for any sort of dead cat bounce, because this time around the markets have looked more exhausted than they have since QE began in late 2008. Therefore, we're on the lookout for signs that maybe this market is going to turn around and head lower at some point. It might not happen today or tomorrow. It might happen in a week or two, but we're going to be on the lookout for that. And as I said, all we need to know is what the market's telling us to do in the present, to know how to act in the present moment, and to keep our essentials very flexible, because this kind of market, as we can see, can change on a dime. It has been, if you look at the S&P, it's been going more or less sideways for since late 2014, and it really was in the last 2 days of the correction that the correction really accelerated and didn't give really much warning at all. But that is the nature of this QE environment, where we are seeing stocks take the trapdoor down and the stairs up. That's why it's imperative this year. We've had some good winning stocks on both the long and the short side, but it's imperative to keep your stops tight and to take the profits when you have them, and then you can look at a year like this year and say, well, you did pretty well, especially relative to what the averages are doing. I believe that the averages now are down for the year, and that's after I think actually the Nasdaq's about break, maybe up just slightly for the year, but you have this up down that just wears people out. If you're trying to time the markets, that's certainly the case with normal instruments like the triple Qs or the spiders. But individual stocks have been a lot cleaner, hitting the right ones, the ones with the right fundamentals and the right actionable buy points. Then you can do, you can handle your position and make money off these things, and keeping your stops tight, it allows you to keep your profits when the market does finally turn over like it did just recently. Now that said, the volatility ETFs have done well by me. So I finally launched the volatility model. It's in beta form right now, so I'm just keeping it on the down low for now. But you all received the first signal, which was a buy signal today, which means that the model feels that the market is going to go higher. That is, that volatility will diminish. And again, this is based on real-time exposure plus back-tested studies. I believe that, like I've said, I've delayed the launch of the model because I wanted to get enough real-time exposure and just to understand the slippage involved. And the slippage is actually virtually zero, so that part is very good. If a lot of the signals will occur after the close or before the open. So in other words, you can get on board at the open and the slippage, I found that I get basically the opening price. The slippage is basically less than 0.1%, so it's very negligible, and I was very happy to see that. The signals that come during the day, if the market's moving fast, you will get the price at that point in time, essentially because these trades are done electronically, and it's quite quick. Or if you have a stop on a particular price, you'll generally get that price, even though these instruments can move pretty fast. But again, I found that if you're not doing more than, say, a couple $100,000 positions, well, I should rephrase that. It looks to me like you could do very substantial positions in these instruments and not move the price much at all because these instruments are so liquid. In my own experience, I haven't moved the price, at least as far as I know, one bit. So I think the slippage is going to be fairly contained, which is good news because, of course, a lot of models live and die by slippage. I myself have created a number of models which look great on paper, but then when you put them in real time, you get the slippage of even 0.3% on each, going in and then going out. That's 0.6%. That could destroy a model. So I've been happy to see that the slippage is not an issue at all in this. Of course, I designed this model this way, knowing that I wanted to keep slippage at an absolute minimum, and that's so far what it's showing. Now, let's see. As I said, familiarize yourself with these instruments because they are highly volatile. Even 1x1s can move very quickly in a short span of time. So understand that your risk tolerance levels need to be in keeping with how these instruments will move in real time. Well, with that said, I'm going to turn it over to Gil. I'm excited to see how this model play out. But like I said, I've been very happy with how it's done so far this year. And this year, I might add, is one of the toughest years for trend following because the markets just aren't trending at all. And what I have noticed is in the back test, once we get a more normal market environment like pre-2009, returns are quite substantial. But again, when I want to go back to one of those non-QE environments, who knows? I mean, QE could be long because the global economy is not turning around. But what I do like is if the market does lose confidence in the Federal Reserve and central banks, and we will see a major correction of ample magnitude, and this model has shown itself to be very, very strong during that kind of environment where people are running for cover. So I'm betting that the QE environment, I mean, how much longer can it go like it has been since, say, 2012 when all the printing presses have been going full bore? How much longer can this last? We know one thing, that is things stay the same, they change. So what are we, 2012, 13, 14, 15, we're the fourth year of full bore money printing. And I think the market has expressed lack of confidence in all of this. So I expect more volatility ahead as a result of that drop in confidence, and ample raised volatility is good for this model. So that's all I got to say for now about it, but expect more updates in the future.
Hey, Dr. K, somebody's asking, will you be adding the trade history for the VIX model to the website? It would be helpful to get a feel for how it behaves.
Yeah, I'm going to be, well, I'd rather not, because the thing about the trade history is it looks great, and I mean, again, in real time it looks fantastic. And I may add it once there's enough good signals on this, but I don't want to look at the trade and go, wow, this model does great. I'm going to start investing more money than I should on the positions. I just want to avoid that. I want to keep the model as neutral as possible. I think posting the values are going to get people overly excited. I really want to avoid that. I really want people to treat this with as much respect as possible regarding their own finances, because these instruments can be very volatile, as we know. So for now, I think I'd rather just keep the model in data form and just send out the real-time reports, when the model does change signals, Just keep it on that very quiet end for now. And then when the model starts to prove itself, then everyone's happy. But the worst thing I could think is I post up all the results. Everyone gets, you know, they don't get gun shy. They go the opposite direction and start investing more money than they should. And then the model has a drawdown. You know, what if from today on the model has drawdown? It's had drawdowns, and I want to avoid that kind of situation where people are putting up more money than they should.
Okay, so what's the market doing here? You had, I mean, if you've been listening to me on these webinars for the past month, I've been telling you, you know, there's shorts everywhere, short sale setups coming through my screens, and just it reached a crescendo about a week and a half ago. And anybody who isn't on the webinars got this little gift here where we put out a report to short Tesla right at the 50-day, and 4 days later you get this massive 20-something% break. I don't know, was that closer to 30, Dr. K? Looks like it might have been. And you get the big flash crash without the flash on Monday. But I think there was some sort of funny business going on because of the way things printed. There's actually a pretty good article by a fellow named Steve Papor and IBD on their editorial page in today's paper. And Steve, I know Steve pretty well. He worked on the floor for us at O'Neill. He was a floor broker, and he had actually come back during the time that I was at O'Neill. He had left O'Neill before I got there and worked as a specialist for a little while, and then came back to the firm as one of the floor brokers. So I spent a lot of time, and you remember, Dr. K, I think we've been with Steve.
Yeah, great guy.
Yeah, and very smart guy, and he understands how the floor works, and he made some good points in this article that I think are valid. Is that with electronic trading, price discovery has become instantaneous, and that is that nobody knows that people want to sell Apple at 92 until they actually see it print. Because in the old days, as Steve pointed out, the specialists, if he saw there was a crush of selling in a stock like, say, Apple, for example, they would delay the opening and then wait a while and call around to see if there's any demand for the stock and have a more orderly opening. Whereas here, you get this nutty opening. I know several people who moved in to cover short positions. We sent a note out, I think, Monday morning, talking about using the crush of liquidity to cover any shorts that you might still have. And that would have worked out pretty well, but I've heard from several people that they got some funky fills. And it wouldn't surprise me. I would be surprised if it was the HFTs that got the best fills, and most people didn't. So I thought that was a little strange. And it's nevertheless resulted in this move that, as I see it, is reminds me very much of May of 2010, the flash crash. And we go back here. I think this might, is this it? No, that's 2011. Here we go. Here's the flash crash of 2010, and you can see that it was similar in the sense that you had this cascading move. The only difference is, if we look at the NASDAQ, we'll put them side by side and get a better picture of what's going on here. You can see that this break came after a nice uptrend, whereas this break is just coming out of this chop and slop baloney that we've got going on most of the year. Okay, so you might say that the market was stronger here and weaker here in 2015, but notice how you have the breakdown day here. Let's see if I can make this bigger for anybody. You can see you have the breakdown day here, and let's go to yeah, that's easier to see. You have the breakdown. Whoop, no, I gotta go back now. The big break here. This is when the Dow went down 1,000 points, like it did on Monday. And then the next day it tried to go higher during intraday basis, and then rolled and went lower. So you kind of you had that also on Tuesday. And then the next day it gaps up. You had a gap up move yesterday. It looked like it was going to give way, and then it held up. And then the next day you move higher, and the next day you move higher. You finally run into the 50-day, and you roll over. So I don't really subscribe to the idea that you can use a chart of an index or a stock from the past to use it as a precise roadmap for something happening in the present. I do think that it does give you some sense of the dynamics of such a sell-off? Because I don't think we've ever had the. Isn't that only the second time in history, Dr. Hay, that the Dow has sold off 1,000 points?
Right, the point basis, yeah.
So yeah, okay. So
Not on a, obviously on a percentage basis, it's had a lot worse, but on a point basis, I believe that's right, because
right,
in
which
2008,
has a certain
the Dow was,
psychological effect.
yeah,
So
that was a lot cheaper in 2008.
right, okay. So you get this, you get a rally, 1, 2, 3, 3 days up. Fourth day it goes a little higher and then rolls at the line. So here you might expect a rally that continues up to the 200-day, or maybe not. Maybe it dies sooner. I think the key is in watching the stocks. And that's basically all I'm doing right now. I use the crush of liquidity actually on Friday to cover all my shorts. I wasn't short anything on Monday. I was a little ticked off, but you know what? I've had a very an outstanding August and made a fair bit of money on the short side, and it's got me up reasonably well for the year, and we'll see how things close out. But I can tell you, last year was up 115%. I was only up about 40 at this point in the year last year. So most of the money I made was in the last third of the year. So I'm looking forward to the next third of the year and see what we get. I'm wondering if we're not going to have a nice bear move. But going back to this chart from 2010, after that rally failed, you broke to lower lows, and then he kind of skidded along the lows. And I remember, Dr. K, we were in New York sometime around in here, I believe, and right at the end of the month, I think on my birthday, at the end of August,
right.
I was on Fox, and we were actually bullish, and so I was telling them that. Nobody there believed it, but the market did come out of that summer correction. But you went into a correction of about 4 months, and I think it was like 17 point something percent on the NASDAQ, so it was reasonable. So all I do here, and it's very simple, I got my handy dandy list. I like the new version of eSignal, which I'm using these days, because it allows you to scroll through stocks. So I'm basically got all my short sale targets. There might be a few that aren't on here, but these are the ones that I put on overnight. And I'm actually short a couple of these. I got a little position here I just put out on Apple. It's coming up into this area of overhead. Maybe it gets up as high as a 20-day. And what I'll do is I'll probably put on like a 10% position, nothing big. And if it doesn't work, I'll just scoot out of there real quickly. Here I'd use a 20-day as where I might add, and then if it keeps going beyond that, I might just bail out. So I keep it small as I'm testing the rally. I don't try to get real aggressive. Usually on the third to fourth day of a rally, I might get more aggressive. So we're actually 1, 2, 3 days up here. Market's up 2 days, correct? And so you might have a little more upside from here. We'll see how this pans out, but you don't know where it's going to give out. So you have to be testing the short side as things are rallying against you, in my view, but I just start out small. So I just made a bunch of money on the short side. My experience tells me that when I'm feeling flush with profits on the short side, that's usually the time to cool it. So my general rule is to operate with pretty small positions and be testing things with very tight stops. Within a few days after I made a ton of money shorting, not a ton, a number of kilos shorting the market over a period of time, say like at the last month. And so all of August pretty much has been a very decent month for shorting. And anybody who's been following these webinars knows that. So I'm assuming everybody can hear me okay. We actually have the internet services back to normal. Not sure what happened last week. My guess is they were working on the pipe somewhere down the street. I don't know, somewhere in the neighborhood. But my home office, I have a special, supposedly I have a special service with Time Warner for business class that gives me priority. But I guess on a day like that, there was no priority to be given. In any case, we did apologize for that, and but poop happens, so deal with it. Anyways. And I think we dealt with it. There wasn't much to say at that point. I think today is a key day because you're starting to get a sense of where things are rallying. So starting with Apple, you can see we're approaching possibly a short sale point, and I think the stock is eventually going lower. But you can see here on the weekly chart down here that you undercut the lows back of August, September, I guess mostly September of last year. Okay, you see that? So you're coming into a spot where it's logical for it to rally, and it does. And now you got the rally that you're watching it to short into, and maybe today's the day to short into, maybe tomorrow's, maybe Monday. I don't know. All you can do is watch the patterns and watch how they unfold and test. And I would start out testing small positions. As you stretch higher and higher, you don't need to have a big position. If this thing reverses and busts 10 points, you don't really have to have a big position to do okay and to get yourself some cushion right away. So, but what I like about the new e-signal is that I can scroll through things pretty quick. So all I do is I have my list here of names that I'm watching, and I just boom, 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 run right through them. I'm short some data here, which is, I think, a little bit weak right at the 200-day. You can see this is sort of a head and shoulders. You can see the head and shoulders here, the left shoulder, the big head with the break down the right side. I mean, this is somewhat textbook, and you break out, but of course the breakout to the lower lows bounces off the lows of this base here and rallies back into the 200-day. I'm shorting it at the 200-day. I'll use that as a stop. If you get through the 200-day, I'm just going to go away. Particularly if the indexes just keep chugging higher, because they can. But you're such a long ways away from the 200-day moving average on the NASDAQ and the S&P that it's not clear to me, number one, how strong the market is and whether it's able to mount a really strong rally all the way up to the moving averages. And number two, where the stocks are, and this is much more important, within their overall patterns. So, so there's one I'm looking at. Facebook is broken down. You notice how it bounced off the 200-day. Now here we come into the 10-day, 20-day, 50-day. That's coming into a place where you might want to look at shorting it. NXPI rallying off of this low. Now notice how it comes all the way into here, undercuts this area here, and into this base. So you're in a logical point for a bounce. And now here you come, heading for the 200-day, which is up around 91.21. But you're at 88.10 right now, roughly right at the 20-day. So maybe if you shorted it here, you would use the 20-day as a quick stop. And yeah, if it doesn't work, just run away. Heroes are zeros, as I like to say. Let the tide shift in your favor. If it's not, if you feel the tide pushing against you, just go away. It's pretty simple. You don't have to marry a stock on the long side or the short side. So that's my general approach. And you kind of see things flopping around. I don't know. A lot of this to me looks like just a big algo party. So anyways, let's keep going. SWK, so right up into the 200-day right here. See that? And again, you come down into this little area. You undercut this little. You have this sort of base on base thing going on, 2 4-week flags. You undercut the lows of this one, bounce all the way down or drop all the way down to the lows of this little structure here. And you bounce them right back up into the 200-day. Maybe that becomes a short right there. I mean, it's in position. Tesla, we gave you that one as a short here. Boom. If you didn't take the profits down there, because I think we set our maximum downside target is around 203, and you were opening under that on Monday. If you didn't take your profits there, you're kind of stupid, okay? And you really don't understand shorting, and you're allowing greed to overcome you, because when you get a break like that in 4 days, you damn well better take it. And to tell you the truth, I wouldn't even fault anyone for taking a profit here at the 200-day, because you're undercutting this low here, and you're running right into 200-day. Now you could have sat with it and waited to see if it bounced off the 200-day, because sometimes they just go right through a little further. But I think at that point you have to be covering your position. If you're not, you're just not really paying attention to the process. Any case, let's keep going. Mobileye. This is another beautiful short. This is a late stage failed, well, it's a failed pod is what it is. And we talked about this a couple of weeks ago. And now it's, whoops, let's go back. It's going right up into the 10-day, 20-day, 50-day. So it's approaching a short zone. It's right there in your face. I mean, they're all right there. So, what I'll do is watch the stocks, and maybe this is where the indexes roll over. We're up 294 on the Dow right now. You can see that. We went over 300. It's kind of gone from fear of losing a bunch of money on Monday to fear of missing the bottom. So, but, if we go back to that 2010 example, I think the break itself indicates that there's a lot of weakness in the market. So whether that suddenly morphs into strength, and I guess in a QE market it might, who knows, expect the unexpected in this nutty market. I would expect us to at least try to retest those lows one way or another. And we did back in 2010, maybe do the same thing now. So anyways, Baidu, you see coming up into this, there's actually a short here. We may have even talked about this. I think Biogen was a short a week earlier, a similar position, and you get the break, and again, it's just so you got to be taking that if you're short this thing. Now you're rallying into the 10-day. It's the 10-day is what? 154.40, so maybe that's where it poops out and hits lower. So Palo Alto Networks, same thing here. I see a left shoulder and a head. I don't know if you want to call this on a fractal basis. If you look at this, here's your left shoulder, here's a head. Get a couple of shoulders cascading lower and lower. Notice how you break a little bit, break a little more, then 3 waves down, and now you rally back up to the 20-day. So if you were short this stock, it's breaking the 200-day, and you're not covering it. You're just not paying attention. And I can't emphasize anymore the idea that when you're shorting in the market, they're throwing you the stocks. The market's busting wide open. You're up 10, 15, 20%, maybe more on a stock on the short side, and the market's throwing stocks out the window. That's when you cover, because you can generally reset on a rally, you know. And you can even be, Bernard Baruch said, it was Bernard Baruch, right, Dr. K, who said that my success I attribute my success in the markets to selling too soon. And I would say I attribute my success on the short side to covering too soon. And so even though I covered all my positions on Friday and participate in the short covering party on Monday morning, I did pretty well. But I run huge positions too. So, you know, there's 2 ways to skin the cat here. You can either take small.
Actually, I think Jimmy Rogers, I know Jimmy Rogers did say that as well.
Somebody.
I know Jimmy Rogers did say that. He said he's the worst trader in the world because he sells too soon.
Right. So look, everybody look it up. So I noticed we're not getting any questions today. I'm really shocked, but I guess the presentation is just so cogent and complete that you don't need to ask any questions. Either that or my internet really isn't working. You can't hear me. But notice Palo Alto Networks is reversing. So right now it's the weakest stock on my list, and you could have probably hit it right at the 20-day. So here we have Google, which is kind of like a Bible gap up that gone bad. So here we are rallying all the way back up towards the Bible gap up level. Maybe it's a short. This is more a market trade. It's going to blow with the market. Otherwise, it was acting strong. But notice how if you were really crafty, you could have used the 700 level as a short sale point. Of course, you know, IBD is telling you it's breaking out and you need to buy the stock, blah, blah, blah. But if you're thinking about Jesse Livermore's century mark rule in reverse, then what you're thinking about doing here is maybe hitting as a short within the context of a market that's also weakening. So you have to take that into account. And I would be, if I saw like other stocks everywhere, you know, other leading stocks all breaking down, Google's one of the last moving up, but I notice it's running into 700 repeatedly, I might go short that stock on that basis using Livermore's century mark rule in reverse in combination with the context of a market that is noticeably weakening, as I can see it in the individual stocks that are breaking down. Okay, so you put it all together. So technically, someone's asking, how come V is on your list? So I don't think I've gotten there yet. Chill. I'm going to run through a couple more. CRM, another one, off the 200-day right into the 20-day. That was a short earlier today at the 20-day. Amazon rallying back above the 10-day. I think it's probably going to roll back over it. But again, this is a market short. It goes lower if the market does. And right now, I don't really see a point where I want to short unless you're going to use a high today as a stop. There are other stocks in better positions. Here comes CyberArk approaching the 200-day. I'd like to hit it at the 200-day if I could. But again, this is you can sort of see a left shoulder, a pinhead, and a right shoulder, and you know, and you're seeing this all over the place. It's not just a few stocks. I mean, okay, here we go, Splunk. This is a big, ugly sort of pod with ladle pod or whatever you want to call it, with the handle long thing, and it's broken down after a failed breakout attempt here, and you're coming up into the 200-day moving average. Are you starting to see a pattern here where a lot of these stocks are rallying into areas of potential resistance? I could see some of them going just a little bit further, maybe if the market rallied again. But if the market gives away today, then this may be where you want to get real short. And so you want to be fluid and you want to be flexible. And if you can't think for yourself, don't even try it. Because I get a lot of people who will start emailing me, I shorted Amazon and Netflix. Is that a good idea? It's like, come on, if you really need someone to tell you what to do, then you really shouldn't be shorting, because it just shows you don't have the experience to do it. I mean, I think you have to be a very experienced trader. You have to be very disciplined. and you have to be very alert and nimble. And if you're not all of those, I think you got a problem. It's taken me a long time to get to a point where I've taken most of my psychology out of it, and I've learned to cover things. And you can read in our new book, Short Selling with the O'Neill Disciples, the precise mechanics of how I do it. And it's just after doing it for many years. And yeah, you don't always get everything. Like I did miss the Monday break. I know a lot of people who didn't, though, and they're very happy right now. Of course, they're not running large positions, but if you do it that way, I think you're pretty much in the ballpark. Anyways, let's keep cruising along here. So Splunk at the 200-day. Workday rallying up. Notice how it's coming into the bottom of this gap. They had earnings yesterday. It's sort of undercutting all these lows on the weekly down here, and then back up to the daily. So we're right up into this low. This could be a point where it reverses. I'd really like it somewhere at the top of the gap at one of these moving averages, but that may not happen. Walt Disney, I remember, who's that guy, Charles, what's his name, on Fox Business? He's telling people, I think on this day or this day, that you got to own Disney for the long term. Yeah, keep owning it. I hope they didn't buy it up there. But this one is starting to look like some sort of a head and shoulders. A rally all the way up to the 200-day would probably be a great short spot. Netflix, this is one of the stronger leaders. So, you know, as a short, it's going down with everything else. But here, I'm not really sure, because now you're trading above this peak, which could be the left shoulder and a head and shoulders, but it's really not clear right now. That's not one really to come after. Baidu right into the 50-day here. I'm sorry, F5 networks right into the 50-day. This is a failed. Here's a big sloppy cup of handle, tries to break out. It fails. So that's a late stage base failure. You're coming right into the 50-day. Twitter's a piece of garbage, but I'm not sure I short that here. I'd go after other stuff. There's so many beautiful, juicy targets. Look at how LinkedIn goes past the 10-day line, right into these lows back from earlier part of August here. See that? And it's reversing today. So, you know, if this is going to be really juicy, I'd love to see it come up to the 20-day. So, and I'm starting to make a little bit of money on the short side right now, with Apple starting to roll in just a little bit and data coming in. There's some others, though, I'm looking at. I mean, obviously, you can see it here. Thinking about putting some others here. Workday is, we looked at that. Let me check something here. Do I have a 620 in here? Here we go. No 620 sell signal here, so nothing yet. Let's get back to where we were. Let's LinkedIn. Here we go. So I mean, you could have tried to hit that one short, I suppose. Not in the juiciest position, but it's reasonable. Red Hat's another one that's been showing up, and this is kind of, I'm just picking this one just to illustrate what everything in the market looks like right now. Everything is broken down. Just about any chart I've looked at of any stock I've looked at over the last several months, either as a buy or a short or whatever, has busted wide open. And now they're all in a similar position of trying to rally back up. And you can see Red Hat, just sort of a random one I threw on there, rallying right back up to the 10-day. It looks like a short there. Starbucks, look at how this thing broke. Rallying back up into the 50-day, maybe a short there. MasterCard, this is similar to Visa too, I think. Broke down, rallying into the 10-day. Here's VMware. That's not doing much anything. That's pretty weak. Sometimes you'll think that, yes, you want to short something that's further up in the pattern, but if you look at this, this is pretty weak here, and it doesn't want to rally much. I'm wondering, you're right at the bottom of the gap here, so you could use that as your stop, you know, 80 level, say, as a tight stop, and then come after it here. And it's weak. So a lot of times what you think is weak, too weak to short, actually ends up getting a lot weaker because it is too weak to short. Follow me? The paradox of shorting. There's Intel looking like garbage. Did you guys catch that? Right there at the 10-day line. Wynn is just breaking down. Las Vegas Sands just breaking down. Avago came out with earnings today. As far as I'm concerned, you can see on the weekly chart, you got a left shoulder, sort of a sloping head here, and slowly downward sloping head, I might say. And you're rallying back into the 10-week line. You're just under the 50-day line, so you know that's looking like a shortable position. Jose is busted wide open. Look at that, poor guy. He's hit the 20-day today and he's reversing. So you're seeing this, and you know, I got a call from an old O'Neill institutional guy this morning, who's now a broker at Merrill Lynch, because the institutional department at O'Neill is pretty much down to like 2 people. It's totally blown up. And as a business, it seems like there's nobody there anymore. But in any case, he called me up and he was worried about what someone else is asking. Is this day 4 of a rally attempt? And my answer to him is, forget about day 4 of a rally attempt. Forget about follow-through days, because they're all BS. They don't work. Watch the stocks. So my view here is we're going to roll over at some point, and I'm watching these rallies and all these broken patterns, and I'm looking to short into this move. And there's the May 2010 example, might add some weight to that, although it's not a precise map. So it's really just a matter of watching how the stocks act, and we can see how so many stocks are acting right now. That's pretty obvious, and you take that into account. So I would be sitting around worrying how many days you are in a rally looking for some stupid-ass follow-through day, because it's useless garbage, and it doesn't tell you what you need to know. The stocks tell you what you need to know. Therefore, my view is that if you're going to turn at any point, you're going to see some of these stocks stabilize and start to set up on the long side. Okay, so that's what you'd be looking for on the long side. And I don't know, hey, Dr. K, are you into this BS with follow-throughs? Is today day 2 or day 3 or day 4 of a rally attempt, and do we need to care?
Yeah, as I think everyone who's been with us for any length of time knows, that in QE environment, it effectively destroys all that follow-through day nonsense. You know, QE has rendered impotent many of these indicators that worked once upon a time prior to, say, 2009. So you know, it's a different ballgame altogether. The last 7 years.
Yeah. So there's your answer. Let's see. Someone else asks. Oh, now a bunch of questions popped up. Is Splunk case an example? In Splunk case, as an example, if it rallies to the 200-day and rolls over, are you always covering when it gets to the low of 55? At some point, the market is rolling over. They have to break the lows, right? That's a good point. That's a good question, actually. So if I set this as, I don't know, this low or this low, I would cut. What I generally will do is, if I short it up here and it breaks, I would cover on the basis of undercutting this. Well, let me bring this in a little tighter. Maybe I can stretch it. So you can see it undercuts this low here, and I would definitely be looking to cover on that and then re-shorting, and I will work stocks like that on the short side. So I would suggest reading the book, because I go into a huge amount of detail on how I work that out using a lot of real-world examples from I think 2014 and 2013, I believe. In my experience shorting stocks, and even I think during the flash crash in May 2010, when I was up like 85% in 1 month. So you know, I would, if it breaks again, then I'd kind of watch and see. So as I understand your question, you're now saying if it does that again, would I cover?
GLOG.
That kind of depends. What I would probably do, if you broke that low, I would use it as a trailing stop. But at that point, I would expect that the 10-day and the 20-day would be well below the 200-day and in a position to serve as a trailing stop. 10-day and 20-day, mostly the 20-day are. The 20-day primarily is generally what I will use. If I've got something streaking to the downside, I'll use the 20-day as a trailing stop. Okay, so that's what I'll do at that point. And really, you can try to work it out different ways. Some work out well for you, and they just keep breaking lower and lower. So let's just look at, say, LVS as an example. You can see here that as it failed in here, it starts to break down below the 50-day. Notice how it's following. It's actually almost following the 10-day, but really it's following the 20-day. And if you're suddenly breaking this low here, and you think you might, you undercut it here and you're rallying, and you think you might want to stay with it, well, you could just use the 20-day or the 10-day, depending on how tight you want to keep it, as a trailing stop once you make the second break. Because yeah, once you have the second breakthrough that cover point, you could be heading a lot lower. And so that's the way I would tend to handle it if I was going to do it that way. But a lot of times I'm just working things on a daily basis. coming in and shorting things in the morning and then moving mostly to cash overnight because of how nutty this market has been. So, of course, that was not so smart on Friday, but, you know, tough problem to have as far as I'm concerned. So I hope that helps, Mark. Somebody says, if the market stabilizes somehow and flashes follow to type strength, what would be the best parameters for finding the best long candidate? So I think I already answered that question in the sense that you'll be finding stocks that are setting up. And I don't, and that's what bothers me right now about this whole market. It doesn't really bother me because it just makes me look at the short side as the side I want to play here, is that you're not seeing any of these things set up. There's almost nothing set up. I mean, everything's getting hammered. Everything's been slammed. Everything's broken down. All the charts are busted. Right, Dr. K, can you confirm that all the charts are busted?
That is the status quo at the moment, yes.
Yeah, seems so. Yeah, that's what I would say. And I'm looking for that. So, you know, make a list of the stocks that are holding up the best. One of the ways I'll do it is running through a buy list. So, for example, just if you're running O'Neill type screens, then you want to do a composite rating over 80 and less than 15% from the 52-week high. And that might give you a list of stocks that are hanging in there. And you want to keep that and just be cycling through that every day to see if things are maybe stabilizing anywhere and indicating that maybe the market's going to turn, because that's what we've seen every time the market has turned. We have seen it. We have seen the individual stocks start to set up. You can see Apple starting to come in. This data's working okay too. I'm looking at hitting some workday here. Let's see. So I'll take a small position here. I just shorted 2,500 shares of workday at 74.41. So, and somebody might ask, well, why did you do that? Because I feel like it. But notice, let's get to the. Here's what I'm starting to see here. You already have the MACD cross. So as it's pushing up near these highs, I'll use the high of the day as a stop, and I'll just put a little bit out here. And that's a small position for me. So, so just test it out, see what happens. It's 748 now, 74. I'm sorry, 74.43 right now. I'm in at 74.41 on 2,500 shares. We'll see. You know, if it comes down a buck, I make my sushi money for the day, I guess. But I'm looking at this as being overhead resistance, and it's kind of in no man's land. But I've got a couple of cover points, a 10-day here at 76.90, which is not too far away, and or just the high of the day at 75.73, which I tend to like better. It's a lot tighter because I can always cover and come back and short it. So my objective is not to get the exact right price. I want to get the lowest risk price entry I can, but I'm trying to get myself in position for a break to the downside. So, and I've already got data and Apple working for me, so I can afford a little bit of fudging on this workday. Okay, so it all depends on what else you've got going on and whether it's working or not. If you got any kind of profit cushion for the day, a lot of factors come into play. So, you know, somebody emails me and they want to know if I held my shorts overnight, and I tell them really none of their business, and they're like, well, I'm just trying to gain some insight. It doesn't gain any insight, because unless you have my exact same psychology, you're not going to run things the same way. You're not going to hold the stocks necessarily heavily overnight if you're me. If you're somebody else and you're running smaller positions, or you're more spread out, I don't know, whatever, and you're much more comfortable holding positions overnight, you would do that. It all depends on what you want to do and not necessarily on what I'm doing. So all that to say is, don't just start doing what I'm doing just for the sake of that, because I screw up a lot. Just want to remind everybody. Your mention of cyber got me looking at VDSI. That is down over 50% since June. Yeah, that's a piece of garbage, isn't it? Look at that. But you can see kind of a head and shoulders up here. So somebody says, oh yeah, one of the Google groups I am on up here is all O'Neill disciples. They are focused on the follow-through day. Makes me think of lions to slaughter. Yeah, it's sort of a cult. And I thought there's a great, I'm reading a book right now. Somebody's been asking me, like, are there any great books on Wyckoff? There's a book that I just started reading, because this guy supposedly is a follower of Wyckoff. And let me pull this out here. I'm trying to remember. The book is called, I think, Trade's About to Happen. Give me 1 second here while I pull it up. Trade's About to Happen, a modern adaptation of the Wyckoff method by David H. Weiss, W-E-I-S, I believe that is. But there's a really great quote in here, and I'm looking for it. Give me 1 second here. You're going to love this. Let's see. Still looking, still looking. Here we go. He says, specificity sells better than intuition. It's more tangible. I believe there is too much dependency on recognizing patterns of behavior rather than on the art of reading bar charts. These patterns can quickly become cookie prints, I think he means cookie cutter prints, like geometric formations into which price movement is stuffed by those looking for a quick, no-think fix. They lead to rigid rather than creative thinking. And I think that's a great quote. You know, I would read the book. I just started. I don't know if it's good or whatever, but it seemed interesting because I was looking for some new stuff on, see if there's any new stuff on Wyckoff. I've read all his old books, Stock Market Technique 1 and 2, How I Trade in Stocks, I think it is. He also wrote a book, one that O'Neill told me to read, I think Studies in Tape Reading by Rollo Tape. That was his pseudonym, I guess. Is that the word I'm looking for, Dr. K?
That's right.
And Bill O'Neill told me to read that. I remember he was complaining to Wiley when we wrote our first book that he never read Wyckoff. I mean, maybe Bill didn't put one and one together and realize that Rollo Tape was Richard Wyckoff, but he did because he told me to read that book. Anyways, let's see. So all that's to say is that I think the Ivy Dweebs are going to get, yeah, they're getting chopped up. So anyways, somebody says, yes, your book is quite detailed, excellent, need to reread it already. Yeah, I mean, it's detailed. That was, as I think I write in the beginning of the book, I thought that was the big weakness of the original book in 2004 that was published in 2004. It didn't really get to the meat of it. You know, like they show a pattern like, oh, you know, like Biogen, you know, and they'll show head and shoulders or failed base short here, you know, and they put an arrow right here. Of course, they don't tell you on the daily chart that this is where they tell you to short here, like you're going to be able to anticipate the gap down. So the reality is that short selling is not all about looking at a weekly chart and drawing an arrow that says short here. There's a lot more detail because you would not have well, unless you were prescient, you wouldn't have shorted it before earnings, I would hope. I mean, unless you're going to play earnings roulette and you think you know something. But for the most part, the actual mechanics of how you get short and a lot of these breakdowns don't really occur the way they look, you know, as neat as they might look on the weekly chart. So, and I think that was a major failing of that particular book. And that's what I corrected in the most recent book. Somebody says, thanks from the guy who wanted to be that fly on the wall. Well, you'd be a bored fly, right? CRM 620 cross. Let's see what they're talking about. Where did you go? Where did you go? Starting to, but notice how you're finding support off these lows on an intraday basis. It's hard to say. I don't know. In this position, I couldn't see the MACD breaking down, but it may be starting to roll. It's definitely in position. If you use the 20-day as your stop, it's definitely in position to push lower from here. So, but it may not do it right away. You know. It's anyways, I'm noticing the workday is pushing away from me. I knew that would happen. Maybe it's going to try and break out, but this thing was down after hours, traded down to what, 66 or something like that. Anyways, but you can see the market's just kind of grinding around, and I think it's probably a lot of talk on TV about how wonderful things are and that you miss the bottom, and so the fear, the emotion of fear on Monday has now morphed into fear of missing the bottom now. So, and you see how that plays out. And it takes some time to dissipate. It may not happen today, so I may be running for cover at some point, but I'm kind of in the ball game right now. We'll see how things play out. Somebody says this guy, I guess the guy who wrote this book, Weiss, yes, he was on SF on August 15th. He presented at the TSA ASF Wyckoff event. Oh, excellent present. I bet it is. The book is good, but difficult to get through. I can read. That roll of tape book is good. The book I quoted was Trades About to Happen, a modern adaptation of the Wyckoff method. So also, you can always go back and look at the video, Just didn't seem to me that bonds got a lot of money in the sell-off. Can you look at a long-term chart of TBT? Bonds, I don't know, I look at TLT, that's one of them. TBT, no, they didn't actually. You saw that the longer, well, TBT is trying to, this is ultra short. Okay, so this is a short one. I go long, I look at the TLT, that's the actual, correlates to the actual bond movement. So, let's see. Yeah, they rallied on Monday in reverse. So I think there's something else going on here, and we'll find out later on. But I don't really like the way things are acting on a global scale here in terms of the global financial system. Something doesn't seem right. Now, I've been talking about that for a while, and we've started to see some of that. Some of the cockroaches are coming out over the last couple of weeks, and there may be more. As anybody who knows anything about cockroaches, if you see one, there's probably a lot more. So we'll see. Anyways, let's see, where was I? Shall we go back? I'm done with my list. Anybody have any other last questions? So I gave you an overview of what I'm looking at and what I'm spending my time doing today. I may not make a bunch of money, so I may make a bunch of money. Market may not roll over, but I'm testing things small, and we'll just see how it goes. If it doesn't work, I'll come back again tomorrow and see what happens. But I do remember in 2010. Let's see, get back to my normal screen here. I do remember in 2010 that, go back there, I was short on the day of the flash crash, and I covered near the bottom. That was very helpful, but I remember really shorting the crap out of this thing. Pardon my French, but shorting it right here at the 50-day, and then this break was really nice. So what I'm kind of salivating over right now is the potential for another break like that. And if we had that, it might be a little more uniform, and you'd be able to milk it a lot better. So using it the sort of in and out method that I use. So I don't know. We'll see what happens. But I think you just have to focus on the stocks, and that's the bottom line. So you can go back and look at this video, and this is a list of what I'm watching on the short side right now, all up and down here. And that's pretty much it. You have anything to add, Dr. K?
I think, well, not really. I basically am watching for signs of basically a rollover. I would like to see resumption of the volatility, but right now, I wouldn't be surprised to see the VIX come off a bit more. And the current signal that's a buy signal. Some of these signals are going to be pretty short-lived, but because these instruments move around pretty quickly, you can grab your 7 or 8% profit sometimes in a matter of a day or 2 days, and then the signal changes. So, and I think that accounts for the success of the model in this very sideways market that we've seen this year, because it is sideways, but it's not monotone. It's not flatlined. So there are profit opportunities for these sorts of instruments.
Yeah, so we'll just go back, and one final review is to keep an eye on how this looks. Again, here was your flash crash, and you rally right in 50-day. A similar rally today might take you up into the 200-day. So I think just watch for how this plays out, and you can see I gave you a list of stocks to watch that are rallying into potential resistance, and I think that's where you may want to focus on the short side. You may have some of your own names as well, but that's my core short list. There may be a few others I didn't include, like Yahoo, maybe Illumina. I think it's another one. Let me quickly look at these. Just trying to reference my list here. And you see the same pattern, rallying up into potential resistance after a big break on Monday. It's all the same thing. So you got your plan, you know what to look for, and we'll see what plays out from there. So Thanks for showing up as always, you guys. I hope this has been helpful. I guess we'll find out over the next couple of days, won't we? And we'll catch you next week. So have a great weekend.
So long, everyone.